most startups do claim the credit, but they're, they have good documentation, and it's a big estimate. But until you're actually using them, states and federal government aren't going to really challenge you. It's when you start to use them, and that's generally when you start thinking about engaging an R&D credit specialist, or someone to come in and do an actual concrete study that will help support those credits if you're challenged by the authorities.
So there's like a whole industry that's developed around claiming this credit?
It's not claiming it. I would say it's using the credit.
Okay.
A lot of people claim it, and do your best to have the documentation in place. But what you're doing is what these credit studies do is kind of prepares you for the ultimate audit. Because if you're using them, there's a much higher likelihood that you'll be audited. It also goes hand in hand with the audit of the financial statements. So all of a sudden you have these outside investors, and they want a look at what your true financials are. And there's some tax assets. So you have tax assets, these credits that you haven't utilized. What's the value of it? Well, we come in as an auditor, and you have 0 records. It's really hard, if not impossible, to give you any benefit from all those credits.
Okay.
So you would need that documentation just to say, all right, here's how we meet the test. Here's the people that were doing the research. Here's the the projects they worked on. Yes, it was uncertain because we failed at here, here, and here.
Right.
So it's building that story.
I'm super ignorant about how taxes work for startups.
Okay.
You get a tax credit and it sticks around. Can you keep rolling? How long can you roll it around?
For federal, you can roll it forward for 20 years. For California, it's unlimited.
And you only really be paying taxes once you're making a net income.
Yes.
Right?
Yep.
So that, for a lot of startups, that could be a while. Sorry, what?
Except for that $800, right?
Yeah, the 800 minimum.
Oh, so that can actually apply.
No, you can't offset.
Like we're starting at $800 matters.
Yeah, you'll have to pay $800 every year for California, but you can't use these credits to offset that $800.
So we all got, a $20,000 grant for being part of the program.
Yes,
if we don't spend that by the end of the year, that'll be net income then?
Correct.
We pay corporate tax on it.
Yes.
Okay.
So I would suggest have some conversation before the end of the year.
Is the same true for, investment for preferred stock?
No, that equity is not revenue.
So if it's all going to the same pool, right? How do you?
What do you mean pool?
Like
it goes into the same checking account.
Yeah, exactly. So we just need to spend $20K on something.
Yeah.
And that's the rough.
So Derek was talking about the income statement. So investment, capital investment, your investors coming in, that doesn't hit the income statement.
Sure.
You're giving up equity in the company in exchange, whereas a grant is, you're giving everything interested in money is granted to you.
Oh, okay. All right. If you have some weird thing like, let's say you buy let's say you own some physical servers in Iowa, but you're actually okay.
Me too.
I know this is strange.
It's not that strange because
but you're really
Different
you're
kind of
based in.
server
Do
farm.
you have to now deal with Iowa, or do you have to? Can you just divide?
Practically, I've
They
never
grew up there
seen
now.
people claim Nexus just because servers reside in another state. Texas might beg to differ.
Oh, Texas.
Yeah, Texas will say servers create Nexus. You have a contract with Dell and they host your servers. Texas has argued that creates a Nexus. I would disagree.
A question about the grant stuff. If you paid out to an employee, because if it's paying up for expenses like computers and whatnot, that's part of the company. But if you actually then give it to an employee to be used for their own personal use, like i.e. rent and such, that's part of payroll and part of the W-2 and part of the.
Yes, if you pay expenses. So let's go back to I think the first topic that Derek said about records. I would advise you to not pay personal expenses.
Okay. Well, you're not. I was just curious.
Okay. No. But may have payroll and just treat it as compensation.
Awesome. Okay.
You have to do the same thing. It ends up in the same way. It's just a little cleaner. So hey, all right, here's $1,000 paycheck or whatever.
But if you do payroll, then you have to deal with W-2 and the whole. Okay.
If you pay rent for someone and you don't pay a salary, that's compensation anyway to them, and you should be withholding employment taxes, income taxes, FICA.
What kinds of benefits would not fall into that category? Like where, would you have to, are there any types of things like, healthcare, I guess, doesn't get taxed in the same way, right? That's usually
Correct.
pre-tax.
And that's the one thing that I was meaning to bring up about payroll service providers. I mean, are you guys offering healthcare to your?
We will.
Okay, and that how do you do that? Do you that they're a third party vendor and just
Yeah.
go like
Yeah,
write
we
it
use
or
it's
something?
I think it's called Sequoia Benefits.
Okay. So there are companies set up that have these plans, so you don't have to go out and negotiate your own with Kaiser or whomever. They'll provide you a benefits.
Other types of things that generally fall into a pre-tax basis, such that you because we're not necessarily paying anything. We don't have any payroll at this point.
Yeah.
So, is there anything that we can provide to each other, as a benefit, without crossing that line and actually providing income?
Nothing is
Like
jumping
cell
to
phone
mind.
bills is often like something that
Well, that
companies will cover.
if it's related to business, absolutely.
Okay, so as long as you can make that argument strongly, then
Yes.
Yeah, like all your expenses that are related to your business, like
Sure.
your laptop, your phone, all that stuff.
Yeah.
Mhm.
Meals and entertainment might be looked at every once in a while, so it's not.
Laundry services.
Lunch every day. Yeah. So, not unless you,
push that line.
if you have a formal uniform policy,
Policy.
then I might find it.
DC sharpless.
I think that's not something.
Yeah.
Really, buying lunch for employees is not considered usually.
There's a few exceptions to it. The bigger companies exploit it when they have a campus because they don't want employees leaving campus.
Right.
And so that helps them be more efficient in the day, and that's what they've argued. But if I go out to lunch, if I take Derek out for lunch, I mean, I pay for it.
What if the company just does it? The company still pays for it, but you don't claim it you just don't claim it for anything. You just don't even talk about it.
How does that
Like
roll
the things
through
that
your
happen
books?
on
How does that
Monday.
roll
Yeah,
through
I
your
know.
income
It
statement?
shows that I never really do this.
Yeah. So I mean,
I'm not saying deduct it as an expense. That's
well,
what I'm
if
saying.
it's coming out of the company's checkbook, you have to deduct it as expenses.
Okay, or make but you're saying you can't.
I'm
Well,
saying be careful.
Okay.
Well, but
That's
then
what happens
all
in
companies
Iowa State.
have expenses that run through the business that may be deductible for business purposes for accounting reporting, but they're not deductible for tax purposes. So when you file your tax return, there's a reconciliation between what
Yeah.
is deducted for book purposes and what's deductible for tax purposes.
Right.
We'll just
And-
deduct those non-tax deductible items.
Yeah, and there are also policies like if you're working late, bringing dinner in so you can work late.
Yeah, I was
And
gonna say.
that's acknowledged.
Okay, you may have mentioned this, but, potential partner comes in town, you go out for a nice dinner.
Yeah.
That's a clear category where we
Yeah, and that's where we have an adjustment for tax return.
Well, meaning only part of it's deductible.
Yeah, 50% is deductible.
Oh,
So
Wait, say
it's the one area.
50% is deductible for tax purposes, for meals and
a
entertainment.
gentle disincentive to spend a lot on that particular dinner.
Oh, interesting. So you still pay taxes for 50% of.
Yes.
I've heard if it was in the office, you can deduct it all then.
If that's because you keep people on site and, yeah, there's those arguments, yes.
Now, in determining whether this is material or not, so if we had a couple, dinners, is that small enough that it's immaterial and we don't even really have to worry about these issues?
Yes, and let me kind of differentiate from what I'm saying. What I was meaning to say was if you buy yourself lunch every day, okay,
Yeah.
that's excessive and that's really a business expense. If you have a team dinner once a month, a Christmas party, that's deductible.
So when you start
50%.
Yeah. Well, no, even those team building stuff, you can deduct 100%.
question, so like when Starbucks provide food for their employees every single day, like breakfast, lunch, dinner, like that's all.
I'm telling you the technical answer.
I got it. Okay.
Okay.
You may have mentioned this already, but what's the proper way to reimburse ourselves for things that we're spending on our own money that we're hoping to be reimbursed for at a funding milestone?
Expensify.
Just expensify. Okay.
And submit it
Okay.
to yourself, so you have
That's-
one hat
that's
on,
really
I'm an
good.
individual, now I'm the business owner.
Gotcha.
Yep.
Perfect.
Related to that question, my accountant is asking if I would like my contributions or my co-founder's contributions to be treated as a loan or a capital contribution, and why would I pick one versus the other, and what do you see that's typical?
Do you ever expect that loan to be repaid?
I would like that to be.
It's easier to repay it if it's a loan.
Okay.
If you just put it as a capital contribution and you make money, then you have to distribute it as a dividend, which is less tax efficient. You don't get a deduction.
Okay.
So it's a little, from a pure tax perspective, it's more tax effective as a loan.
Okay. And we
But you
haven't
can't
applied-
just loan everything. There's some other rules that you have to actually have enough capital contributions to get the business moving.
Okay. And we haven't applied any interest rates or anything to that. I mean, can we go and do that, like back apply that, or is it
Yes, yes, and that, yes.
Okay.
And I assume it's all started this year?
Yeah,
Yeah.
pretty much most.
So, I mean, and
Some last year.
and it also depends if you're, on the cash basis or accrual basis. If you're on the cash basis, you haven't, you are on the accrual already?
Yeah.
Okay. So there's some
Does
other
that
rules.
impact-
Pardon?
Does that impact anything?
Well, you should be accruing for interest.
Okay.
So, and the IRS puts out reasonable interest rate
Okay.
tables.
Should have the same question.
Okay.
That was,
Yeah.
that was awesome.
So, I mean, but some of it's, yeah, that's great to do, it's more effective, but, if you're looking for someone else to come in and invest it, and you haven't put any of your own money in the company, why would someone
Yeah.
come in and put their own money in? So, some of it's optics, some of it is, even if someone came in and invested later, they might just wipe out that loan, so they're